Hey guys, welcome to today's show here on the Leadership to Wealth podcast. We have a returning guest who we had on last year. For those of you that remember Grant White, we have Grant back on the show, of course, from Endeavour Wealth Management. And we've had so many things occur in the world, in the economy, in investing over the past year that we asked Grant to come back and share with us his insights. We had some speculations as well, but we talked about everything from the war overseas, as well as crypto, stock market, real estate, interest rates, and the volatility that we're seeing across the board, and what that means for you, me, and our investing portfolios and building wealth. Today's show, Grant White. Okay, Grant, there is so much going on that I know that we can talk about. Obviously, first, I'm glad to have you back on the show. Glad to be able to chat again and find out everything that's been going on. But first and foremost, how are you doing, my friend?
I'm good. I mean, this is, it's been an interesting year, obviously, to say the least. And interesting is, putting it mildly in some cases. But no, I'm doing really well. I mean, I just got back from Portugal a couple of days ago. Had a good time with family, and was there for some meetings. So I can't complain too much.
Nice. How is Portugal doing? I mean, obviously, Europe right now there's a lot of concern about what's going on in Europe, and definitely headed into the winter. Since you were there, can you tell us what the sentiment's like over there?
Yeah, I think people are doing actually okay. I mean, Portugal and Lisbon, where I was, seems to be doing just fine. To be quite honest, like people are out and about, they're spending money, they're doing their thing. So I think that there's this overarching concern that I think it's right across the globe about a lot of things. But it's not getting in the way of people going on about their days and living life in most countries, obviously, outside of like Ukraine and other places that are feeling that. But in saying that, Lisbon was great.
Well, interestingly, my daughter told me that Lisbon has one of the world's greatest libraries or bookstores in the world. There's a real specialized bookstore that you can go in, and apparently people love going. Do you know about this?
I was spending too much time eating seafood and drinking port, so I don't
know. That's great. Well, glad to hear. This is actually probably an interesting topic to be able to get into some of the things that we're going to talk about. Because we've seen so many things happen this year, and rather than jumping back to the beginning of the year, let's just talk about a little bit of this impact of the war in Ukraine and what you're seeing economically as it's affecting Europe, as it's affecting the world. Do you want to touch on this topic? Are you feeling like let's see?
I think we have to. Yeah, I think we have to. Yeah. I mean, I mean, certainly there's a number of things that are impacting the world right now, and if there's a top three, Ukraine is in that top three for sure. Yes. Because I mean, not only is what's going on devastating. I mean, I want to take that aside for now because we all agree that it's devastating. What's happening from an economic perspective because of it is we're still experiencing a lot of supply chain issues in the world today that we're still recovering from the pandemic. And we also have other concerns like energy, like a bit of an energy crisis going on because of boycotts of Russian energy. And then there's, of course, like food supply and food security around the world. I mean, Ukraine is a major producer of grains. And, what does that mean for the rest of the world? Now, there's deals in place to continue to move grain, but in saying that, there's a lot of disruption obviously going on in Ukraine right now. And so there's a lot of concern about what that ultimately means, and the war continues on. So is it going to have longer lasting impacts? Historically, what we've seen from conflict like this is that, even within 12 months of the start of the conflicts, typically stock markets tend to move higher. actually during that period of time, which is counterintuitive to what most people would think, but they do. And part of the reason for that is stock markets are forward-looking, and they're looking beyond the events already to what's going to happen afterwards. And so, historically, for investors, if you're looking at what the stock market's likely going to do, probably the next few years would look actually pretty good, despite the fact that there is a war in Ukraine that it still rages on, and it looks to be far from being resolved at this point. So, we'll see. We don't know exactly how that plays out. There's a lot of volatile things going on related to the situation, and there's a lot of saber rattling going on between the Western world and Russia and what that all means. I think a lot of it's I'm not a political analyst or scientist, but I think a lot of it is more rhetoric than anything. It's obviously posturing, but at the same time, it doesn't give anybody great confidence over the short term when these things are going on. So that volatility, the volatility we've seen, will remain for at least a little while longer.
Mm-hmm. And I appreciate you stating that. Obviously, neither one of us are, geopolitical, any poli-sci guys, but the reality is we look at these things as it relates to our individual markets, our investing and what it means for ourselves and for our clients, right? For our partners. And so now one of the things I've just got to ask you about that, it's always been said that wars usually make a presidency, and sometimes you need a war to get you out of some tumultuous times. And history has shown that some have been known to do that. Do you think that this is legitimate, or people have seized an opportunity to really do something with regards to the economics in behind the scenes?
Oh man, I think there's always a narrative behind these things. There are reasons, and the reasons could be different. I mean, if you're talking from like Vladimir Putin's perspective on why this is important, they obviously have their own reasons. They obviously have, or he has his own reasons, I should say. I don't presume to think that the Russian people feel on a grand scale that this is a good thing. But Vladimir Putin obviously has his reasons. And what
to me, I think we're seeing more of an issue from the other side with regards to the U.S. and Biden specifically, as opposed to Putin, because I think Putin's actually made it pretty clear for at least a decade that, hey, you're not allowed to bring the UN into Ukraine. They push that, and knowing that he said it for this long. So it really looks to me like this is more about Biden trying to get a distraction.
That's an interesting theory. You know what? I would tend to steer away from the politics of that one, but hey, we know politicians. Again, there's always agendas playing out. They're in an election year. The midterms are coming up as well. I don't think personally, I don't think anything going on in Ukraine is meant to distract from the U.S. politics that are going on. Okay. I think it's just too heavy. It's not. Yeah. This isn't good for the world, in my opinion. It's too volatile. I think you even have China looking this and saying China was trending in a pretty good direction. If you're China, they were growing at an incredible rate, and there was a lot of things going right for China. This is a major disruption to those plans. Instability in the world was not necessarily what Xi Jinping in China had ordered, because things were going the right way for them, Now, where this all ends up, we don't know yet. But truthfully, I don't think this is good for what the U.S. is looking for right now. Either it's causing a lot of headaches on energy prices, it's causing a lot of headaches for inflation, and it's actually working against, if Biden was responsible, it's actually working against, I think, the Democrats' agenda in the midterm elections. I don't see that personally, Neil, but like I said, there's always underlying things that we don't understand. We don't know.
So that we'll go with the disagree on that one. That's great. Sure. Great content. The viewers can let us know what they think on that. But we all accept and understand that it has a part to play in what's going on. Even as we watch the impacts of the ruble going up, or we watch as China and Russia, India are trading oil in something other than the U.S. dollar. a lot of disruptive forces there. What does that mean? That kind of stuff mean for us in our investing in back here at home?
Yeah, well, so the U.S.
Do
dollar
we need to be concerned about what's going on over there?
I think you got to be concerned.
Okay.
But here's what it means right now. The U.S. dollar has actually appreciated an incredible amount this year. Why? Because when people get scared, they fled to
Grant, why has the U.S. dollar appreciated so much this year?
Because it's still the safe haven of the world. That's the reality of it. Listen, I'm not saying there aren't other things out there that could but here's what's happened this year. Cryptocurrencies is cratered. Crypto's cratered. Gold itself has not done fine. I actually don't know where it's at on the numbers for the year, but it's not been the safe haven that people have necessarily flocked to. What happens time and time again, this won't always be the case. I fully admit this will not be forever. But again, this year, the U.S. dollar has appreciated. So what does that mean? Well, for investors, like we still hold a number of our holdings in U.S. dollars. So what does that mean? Well, that's gone up compared to the Canadian dollar because of the currency they're in. So that's had a safety impact in clients' assets. But that's why that's meaningful to investors. Is currency does matter in these cases. Now, I over the long term, the currencies tend to work themselves out. It tends to be ironed out. So, but I think what you're seeing right now is that once again, the U.S. dollar, not cash is king because inflation is eroding cash dramatically. And so sitting on cash is guaranteed losses of 7% per year, basically right now.
Yeah.
So, but the U.S. dollar has again outperformed this year in this type of environment. It won't always be the case. And I know, hey, China would love nothing more than another country's currency to be the world reserve currency. But the reality is it's not there yet. It's probably not going to be there for some time. Yeah.
I actually had another guest on that was saying that, they really think that we're going to at some point get back to a getting backed by gold or something, like we are going to stabilize it again. And I thought, I do not see a near future without a complete collapse of us stabilizing the currency again.
The reality is there's not enough gold in the world to make it work.
Yeah, without a collapse. There'd have to be a complete collapse so that the dollars dropped, so that all of a sudden it became, it equalized again. Yeah.
There was a reason why we went away from the gold standard. There's a reason why, and the reality is governments needed to take more control, and there's a whole huge expansion that happened. Actually, Mark Carney, in his book Values, I think it's called Values, talked specifically about this, about like why we had to get away from the gold standard, and it wasn't just like North America, like it was everybody had to get away from something like that because I think he actually specifically talked about the UK because like the reality is the needs outweighed the value of like the physical gold that could be stored. And so now again, there's an argument to be made that you should still hold gold. For sure, there's an argument to be made there. I'm not a big advocate of it, but I get it. I understand that. But to go back to the gold standard, honestly, like that would, if we had to get back to that, that's pretty catastrophic, I think. And I think it'd be pretty bad.
Yeah. Look, I like the gold standard from a standpoint of it limits the amount of manipulation that can occur through governments, right? In terms of what they do to the currency. And so that really evens out a lot of things for its citizens, and specifically if the world is all backed against the US dollar, it really evens out things for the entire world. Unfortunately, to what you're talking about, the world, and not just the world in terms of governments, but people have gotten used to this environment where governments are able to, central banks are able to vary interest rates. And there's a very key piece there that us as human beings are not prepared to go back to that type of world. I don't think people understand what it would look like to to have a situation where you can't just inflate currency, and it pretty much wipes out what we've got, right? So all the people that are romanticized, look, I like gold, I like precious metals, don't get me wrong, but I think the people that romanticize about it also don't see the full picture.
I don't. Yeah, I agree. I don't think. I think he should. Again, Mark Carney. Whether you're a fan of him or not, that's fine. But I think he's a pretty smart guy. In his book, he talks a lot of the reasons about why we had to go away from the gold standard. And I think if you understand the reasons why we had to, you'll understand why we can't really go back to it. Now, this isn't to say. It's not to say the U.S. dollar is going to be the reserve currency of the world forever. It won't. It won't. I'm telling you right now, it won't.
Yeah.
Ray Dalio, actually, from Bridgewater. Bridgewater is the biggest hedge fund in the world. Ray Dalio, one of the smartest investment minds in the world, I think.
Absolutely.
He talks a lot about this in his book as well. There's another book for you. I think it's called Changing World Order. It's the title of the book. So he talks about the rise and fall of basically the superpowers that the world. Now he goes back, I think, 500 years. And he fully admits that that's not a complete history of the world of humanity, obviously, but it's as far back as you have time to go through, basically.
Yeah.
But he talks about the rise and fall, and what he believes is that the U.S. is actually now on the decline. It's still the superpower of the world, obviously, but it is on the decline. China was on the rise. By the way, China's been the superpower and fallen multiple times throughout history. Yeah. So these things tend to go in cycles, is what he's arguing here. Now, one of the last things to happen when you lose your superpowerdom, if you will, is your reserve currency. You lose your reserve currency status.
Yeah.
So that is an incredible power that the U.S. has. We're seeing it again this year. And it's not something that's going to go away overnight. I don't think, China could be the largest economy in the world in the next 20 years. But that doesn't necessarily mean that they're going to have the reserve currency status. Because again, in order to have reserve currency status, the rest of the world needs to trust your currency. And that's a big thing too.
Yeah.
Now it could achieve that status in time. I don't know. It could be a block of cryptocurrencies. Could be that,
oh my goodness. Wait, are you saying that crypto could take over as the reserve currency for the world?
It could. Is it ready for that yet? No, absolutely not. I mean, and what is it going to be?
Are you sure your board of directors are going to let us publish this?
Well, hey, listen, I'm not against crypto in any respect. I think that there's something really to admire about the technology, especially. Mm-hmm. Where crypto needs to go, though, it needs to become a hell of a lot more stable than it is. I mean, the volatility that you've seen, that alone is the reason it won't be that. Not yet.
Right.
And whether you're talking about Bitcoin, Ethereum, whatever, there's so many of them. I think we need to, that needs to be consolidated a lot more. And there needs to be a general consensus that it's a currency, not a speculative asset.
Right.
Speculative asset like they are today, then it won't achieve that status. No.
Yeah. Yeah. Well, it's a the unfortunate part about crypto right now is for me to win, you lose, right? Because I buy the crypto, and then for me to get my money, I have to sell it to you at a higher price.
Right. Exactly.
Right. At the end of the day, that's the game of that. And so there isn't sort of this, like real estate where there's always a win-win down the road. You can always gain that way. It's a little bit different of a game, which is why we really need the underlying technology to continue to develop, I think, which is what you said.
I think there's a lot. Yeah, the story continues on. Cryptos aren't going away. It's certainly not at this point. I think it'll be really interesting how governments react to cryptos in the future. I mean, there's going to be a lot of probably changes, and governments are probably going to adopt a lot of the technology that is the underlying foundation of many cryptos into their own currencies. And so, what does that mean? So anyway, long story short, is there's many pages left to be written in that story. And we'll see where it goes. But as of today, and as of the foreseeable future, the U.S. dollar will continue to be the reserve currency of the world because people are too scared to do anything else.
Yeah, that's a good point. You create far too much instability by trying to pull it off right now than just staying with it. with the volatility that you have. What do you make of for instance, in our last budget, the Canadian government, Justin Trudeau, actually outlined that we as Canadians are interested in looking into a digital currency, obviously via the government. What do you make of that? What are your thoughts?
I think a lot of it up front is that they're paying lip service to to the technophiles out there, and just saying like, it's something we're looking into. But I think they'd be silly not to be looking to adopt a lot of, like, again, the underlying benefits of a cryptocurrency that they can incorporate into the Canadian dollar. The Federal Reserve is looking at the same thing in the US. And so there's a lot of benefits. There's a lot of benefits for them as well. So long story short is I think they'd be silly not to be looking into that. And I think likely, in the not too distant future, really, like, physical cash. Like, when I was in Lisbon, I had physical cash on me, euros. I hadn't held a lot of physical cash on me in some time. Yeah. So, like, digital currency is the logical step, and we're not that far away from it. The reality is, like, there's some underlying technology that needs to be added probably to make it better.
Yeah. Well, I think the concern that most people have with that is we're all, first of all, we're pretty much a digital society already, right? We're already transacting with our credit cards and debit cards.
Yep.
Cash is a very small percentage of the monetary system anyways. So the real question is that's the concern, I think, for people. And we hear it a lot out of the States, but I think it's even here for Canadians, is the privacy aspect. Being able to, the government being able to transparently see all of our transactions is something that is a concern to people. Being able to track all of that. Is that, and should that be a concern for people? I know we're getting off of, the investment side, but just as human beings, what do you think?
Matt, that's funny. I see a rabbit hole, and I think we're going to go down it here.
Well, hey, if you want to go down a rabbit hole, I'll follow you down. But yeah.
You know what? Okay, I'm of two minds of this. Personally, I don't worry about it too much. That's me personally. But I understand that people have different levels of wanting to be private with how they spend their money, and they don't think the government has any need. And I think in the U.S., it's actually more so, to be honest. I think that a lot of Americans, they still have that distrust for government that, frankly, the whole country was founded on distrust for government. And so that is built into the DNA of Americans, much more so than Canadians, in my opinion. So is it important to have privacy? Yeah, I think it's important. I think it's important that companies like Apple are stepping up. Now, I get it. Apple's doing it for other reasons as well. But I think it's important that technology companies step up and say, no, we're not just going to hand over private users' data and stuff like that. And I think that's important on the money side as well. But I think it's also important we're not naive about what people know and what companies know and what governments know at the same time. The reality is everybody's walking around with one of these. And I'm holding up my smartphone for those who are listening. But I think they don't want to be tracked. They don't want to they want people. It's like, well, then you got to stop. You literally need to cut off everything at this point. You need to not have a smartphone. You need not have credit cards, obviously. So it's a question of what is your convenience worth to you? Because the reality is the convenience of everything and the technology behind it comes with the consequences of probably losing some privacy. And so where's your comfort line for that? I'm not so worried about it personally, but I get why some are.
Yeah, I think it's definitely a question for the demographics, because if you've grown up with a certain amount of privacy and now you see some infringement on it, you have an issue. Someone who's already grown up in this environment, they have no problems with that, right? So are there concerns? I'm sure there's probably many concerns, and someone will find, here, this is just part of being a human being, that we find some way to manipulate that new aspect that's part of all of it, and then we have to learn.
It's a slippery slope, though, for sure. We don't want to go to that authoritarian type government where they control They control our data. They know, all that stuff. Obviously, we don't want to go there. So there is a fine line, and I get that.
And anyone that's ever read 1984, in school, like we're past we're past a lot of that book, right? I mean,
no doubt. I mean, and it's going to continue to get smarter and smarter. And so, but I also think that, like, for example, going back to cryptos and how, part of the point of was privacy and like cutting out of the system a little bit. I think it's a bit naive to think that that's completely off the grid. That's completely, like not traceable, because I think the reality is, I think that's just naive. I think that there is tracing going on, and I think that, especially if the concern is over, like, for example, like criminal activity related to cryptos, all of that type of stuff. The reality is they're getting smarter at tracking it as well, and so I don't know. I just think that if you think your physical cash is going to be the thing that saves you, I don't know. I'm not necessarily buying it.
Yeah, I hear you. Okay. Wow, we went into so many different things there. Let's come back home. Let's talk a little bit about what we've been seeing this year. Interest rates destroying the cause for what's going on in the markets, or not?
Oh, definitely a part of it. Definitely a part of it. Again, here's the reality of where we're at. I mean, we've gone through a pandemic. We're arguably, I guess, still coming out of it. So we had all these issues created by the pandemic. A lot of money printed, and I think it goes beyond that, though. Like, you have to go back to 2008 to talk about the inflation story, because we've been printing money basically since 2008.
Yeah. So
the number one tool that central banks have used to combat inflation has been increasing interest rates. That's the number one tool in their toolbox. It's kind of the easy lever to pull. It's been an interesting time, because certainly not in my career have we seen interest rates climbing so rapidly.
At this pace, right?
At this pace. Yeah. And so what has that done? The thing that the stock market hates the most, and I'll treat the stock market like it's a living entity. It's, obviously people underlying, but the thing it hates the most is uncertainty. And what this has done is create a lot of uncertainty. Central banks have basically said, we don't know where it ends. We don't know how high we have to go with interest rates, but if we guarantee you, what we will do is bring inflation into line. So what they're doing with interest rates with inflation, is they're telling you, we're going to take a sledgehammer to what you think is going to happen. We will not allow inflation to go higher. And the reason for that is inflation is actually largely, the reason for inflation is actually largely in the human psyche. If we believe that we will pay more for something a year from now, you can rest assured that we will make sure that we pay more for it a year from now. What the central banks are telling you is that we won't allow that to happen. So if we believe that we'll pay less for something, or we'll pay the same for something, largely that's going to happen. And that's kind of how inflation works. To a degree, that's a big factor in inflation, is what we believe. So they're trying to change our mentality over what the pricing is going to be in here.
And can we just get an example of that? I think when we're talking about the housing market, it sort of makes sense. So what I'm hearing is, and just for the viewers, when you've got inflation, people are worried about the price being more in the future, so they're trying to buy it today while it's still low, versus the other sentiment of, hey, perhaps prices are dropping, now they hold off because, hey, I could get it cheaper later on. Is that a fair description?
So yeah, to a degree. I mean, it's also saying that, so in the case of real estate, it's like, I'd rather buy it today because I think it's going to be 10% higher next year.
Yeah.
So that's part of it. If it's a purchase that you're going to make next year, though, anyway, it's like you're being prepared to make 10% higher purchases next year as well. So, like, housing is one thing. If you're buying a house, you're probably only buying, like, the house you're going to live in. I mean, you're only going to buy that. You're not buying it this year and next year. You're just buying it this year. But other things like, even groceries, like, that has a cumulative effect. It's like, I'm going to keep paying, like, bread's going to be 10% more next year. So I'm going to keep buying it now, and I'm going to expect to pay 10% more next year for it. So those things that we're buying on a regular basis, the things that make up, like, the regular consumer goods. So what they're doing is taking a sledgehammer to it. There's two effects to it. One, I mean, rising interest rates, as they're telling you, we're not going to let this happen. Two is they were literally pulling money out of the system. We are taking money out of the system. We are reducing it, and we are slowing this economy down because not only do we not want you feeling like you're going to pay more, we're actually going to try to restrict your ability to pay more to a degree because everything's gotten more expensive. Absolutely everything.
Yeah.
I mean, interest rates has a cumulative effect. It's one of those hidden taxes, if you will, that goes right across the board. It impacts your ability to buy more properties, more real estate, a bigger house, whatever it might be. Impacts your ability to borrow more to buy a car. Like, look at even like, look if you're leasing or buying a car right now. Like what you would have paid on a monthly payment a couple of years ago is so much different, even though the cost of that car might be the exact same or maybe even less, but your payments are that much higher. So your ability to spend that much more money has been absolutely restricted in this environment. What I think is dangerous about it is those, when they were they just raised rates, say, for the Bank of Canada, raised 0.5 point again today. That won't, the impact of that won't hit the economy probably for about 6 months. Because that's how long it takes for an interest rate hike to kind of work it through the system. So how many hikes have we done this year? I don't know the number. We've done a lot. We've done a lot of hikes this year, and how many of them have happened within a 6-month time period? Many. And there's probably going to be another hike next month, frankly. So we're not even allowing these rate hikes to take effect, really, before we're increasing rates again. Now, that's planned. The central bankers, they're not dumb people. They're in most cases quite smart. So they know that, and they know they just can't raise rates by 5% at one time because people will lose their minds. So they're doing it on a steady basis. But, what's happening today won't probably take effect for 6 months, basically. And so I think the danger in that is if you raise rates too much and slow the economy down too much, obviously, I think the recession part of it's a foregone conclusion. But the damage being... Wait a
minute. What's the definition of a recession? I hear that it's changing these days.
Yeah. Well, the technical recession, right, is 2 quarters of decelerating growth economically of GDP. So have we hit that yet? Technically not in Canada. The U.S. did actually hit a technical recession. Yeah. They came out of it because they had 2 quarters and then they started growing it. But I think realistically we're going to hit a technical recession in 2023 in Canada and the U.S. That's not the end of the world, by the way. Recessions come and go. We see them quite regularly. That's fine. But what I think is more concerning, and I'm not a doomsayer, but what I think is there's surprises that are out there that we don't know about yet. There's companies or pension funds or whatever that have taken on too much debt, too much leverage, and this rapid increase of rates is not allowing the system to adjust. And so there's probably going to be a company or somebody or a fund out there or something, or maybe many, that have taken on more leverage, and now it was manageable before, but when rates jumped up by 4.5%, 5%, whatever, it's no longer manageable. And so can they work their way out of it? Maybe, maybe not. Yeah. So I think there's some surprises out there. So far, they've all been manageable, to be quite fair. All of those things have been quite manageable. The questions and the ones you don't know about. And the longer this goes, there's probably going to be some that we don't know about. So,
Yeah. Well, I like what you're pointing out because people always wonder, why do we have this protracted event? Why do we keep, they raised a little bit, and why don't you just do it and get it over with? Take the medicine. And I think what you're pointing to, and I appreciate it, and I hope the viewers, listeners are appreciating this, is that by staggering those, it actually gives people a runway. It gives them a ramp to be able to go, this is going up. I need to make some adjustments. And the government's also tried to be fair in the sense of trying to say, hey, we're probably going to raise rates again, but they don't want to just go right out and say we're definitely going to do this and freak everybody out. They have to understand that people are at all different levels and with comfortability, and so they kind of give that message, even though you and I already know that they're going to, even if they say we'll consider it, we know they're going to raise rates just off of understanding the connection between Canada and the United States, right?
Well, and I think what's interesting in this economy is that it's actually held up really well. Like there's things that, and like employment, for example, it's held up really well. There's lots of jobs.
I am amazed at how employment has held up to this. I'm amazed. I've written about it a couple of times on LinkedIn, and I'm actually amazed at how few jobs we've lost so far.
Yeah, well, that's just it. I mean, in fact, there's lots of jobs still out there, and so that's what's giving them confidence that they can continue to raise rates. If that story was over, if we were already in recession, from especially like an employment recession, then I think that they would be second guessing or double checking themselves on this. But the reality is, things have held up. Even consumer spending to date has held up really well in North America. If that starts to slow, if everything starts to slow, then that's the things that they're monitoring very closely right now. Because they are going to probably force a recession here.
Yes.
And then what could happen? I think that likely what will happen, even I don't know, maybe the second half of 2023 is actually rates will start to come down a bit because naturally they're probably going to overshoot to the upside to combat inflation, and then inflation numbers will continue to fall. I believe they will anyway. And then they'll probably come back on rates at some point. I wouldn't expect they're getting back to zero though. Like I think they're going to come back a little bit though.
Well, okay, so tell me this. In your opinion, is do they not have to raise rates until we pull back on our spending? Like, isn't that the whole point? Like, we're overspending, we're spending money we don't have, we're dipping into credit, we're doing all this stuff, and don't they have to raise rates until that pulls back? Like to me, when I see how consumer spending is going, I'm like, oh my goodness, we haven't pulled back enough yet. They're going to have to keep going until we pull back.
So it's not spending so much; it's the increase in like the pricing. That's the problem. Like we actually really want people to keep spending money. We just don't want the price of what you're buying to go up 10% a year or 7% a year. We want it to go up only by 2 to 3% per year. 2% is ideal. We're not getting back to 2% though, probably for the next few years. But I think what they need to see in a meaningful way, the good news for anybody who holds like market related assets though, is the market is not going to wait until inflation is back at 2% before it moves forward. What it's looking for right now, all it's looking for is a meaningful drop in inflation. That could mean it goes from 6 down to 5 or whatever, that's all the market is waiting for, because that's the signal that what the Bank of Canada and what the U.S. Federal Reserve is doing is working. Yeah. But I think the question mark out there is, are there other factors at play that are outside of the interest rates that are contributing to inflation? And the answer is yes. Supply chains have really contributed, or rather, the destruction of supply chains during the pandemic is still a contributing factor. Now, the good news on this is that that's not going to last forever. Supply chains are coming back online all the time. China, for example, I mean, they've been doing these lockdowns. They had a zero tolerance policy basically for COVID, and so that is loosening, which should open Chinese supply chains up, which we order a lot of goods and stuff like that from China still in that part of the world. So as supply chains come online as well, that's going to help reduce inflation as well. So there are factors that are all coming together that are going to contribute to inflation dropping down. The question is when and how fast is that going to happen? And nobody really knows that right now. So are they going to continue raising rates forever to get inflation in line? The reality is they can't. They can't, because at some point it becomes too destructive to the economy. Mm-hmm. They haven't encountered that point yet. We're not even really that close to it yet. But I do think that once we go into recession, then that's the point where they're going to start managing that a whole lot more closely. But what I think is going to happen is we're going to get another rate hike in December, and then there's going to be a pause, and then a big assessment period. How long that lasts, I don't know. But I think that you will see some meaningful inflation rates coming down by that time. It's not going to get back to 2% though in the next year or two though. So I think people need to be prepared for that. It's going to take some time to get back to that.
Yeah, I agree with you there. So here's the real question. I mean, we've gotten into a lot of these different factors. Now the question is, how have you had to adjust, and how should people be adjusting? How have you adjusted, for your firm through this year, and what should people be looking at to when it comes to building their wealth and investing?
Yeah, that's a good question, because that's what this is all about. The reality is, I think what this has shown you again is that some traditional investments that you would have used have not performed as you might have expected. And I think what this is to say is that, so typically people have a very short-term view of how things work from an investment perspective, or even economically. And they tend to keep it within their lifetime. So they tend to only look at what's happened in their lifetime. So for me, I'm 30, just turned 38. So if I only look back over the last 38 years, the stuff that worked over the last 38 years is not necessarily stuff that's going to work over the next 38 and hopefully longer years for me. I think you need to do, and we were talking about Ray Dalio earlier, I think you need to look back much further than your own lifetime. You need to look back further even than your own, the last 100 years, and look back and say, what other things have worked during that period of time? And with the understanding that, frankly, obviously technology and things advance beyond what's happened, 200, 300, 400 years ago. But there's elements of looking beyond the cycles of things that happen within your lifetime. So typically, an investment portfolio, these portfolios became famous for the last 50 years, the 60-40 balanced investment portfolio. What happened in the last year, over this year anyway, is that bonds, typically, safe assets like government bonds, have dropped significantly this year because of rising interest rates. So they're down anywhere from 10 to 15%, depending on the length of the bond. 10 to 15% in what was a risk-free asset, So that's down 10 to 15. Stock market, if you look at the U.S. markets, you were down 20 to 35%, depending on the market you were looking at. Let's just look at the S&P 500. It's broad, so it's 20 to 25%, give or take. Yeah. So that was down. Your bonds were down. So everything was down. Everything was down that you want. There's other assets though, and like real estate. Obviously, real estate's an asset. There's other types of investments. We use We use what we call market neutral investments that are agnostic of market movements. They should perform. The idea is that it's not a perfect thing, but they should perform no matter what the market conditions are, because the hedge against market risk. And there's a whole bunch of different assets. Private equity.
Wait! Don't pass over that one. What's a a type of agnostic investment that you're referring to? Give us an example.
So if you go back to the beginning of hedge funds, actually, now hedge funds have been blown up, completely blown up. The hedge fund is now a big broad term that describes anything that doesn't fit a traditional investment. But the original idea behind a hedge fund was it was going to hedge against market risk. So what I'm talking about is not a hedge fund, actually, but it's based on the original principles, where you can go and buy an asset class or buy certain types of assets. Could be stocks, could be commodities, whatever it is, could even be real estate, whatever. And what you're also going to do is essentially bet against other assets, or maybe even the same asset or whatever, to create stability in the portfolio. And the goal behind it is not what hedge funds have become. The goal is not to make double digits, it's type of returns. The goal is actually just to get a consistent 5% per year, no matter what the market is doing. And we'll just the stock market as an example. If the market's down, it's trying to still get the 5% because it's going to be betting against or hedging against risks that are in the marketplace. So, for example, one of the funds that we own in our portfolio is by National Bank. It's called the National Bank Liquid Alternative Fund. And what they buy is ETFs, or exchange traded funds, that are buying into commodities. And then what they're also doing is hedging against certain risks out there to try to create more consistency in the returns. That particular investment has done extremely well for us. It's probably been our best performing, one of our best, if not our best. Because it's hedged against a lot of the market risk, and it's completely different than the traditional investment portfolio that's out there right now. Mm-hmm. Now, at the same time, so that's great. That's what's happened over the last year, but what's going to happen going forward? There's actually a really good argument to make that that 60-40 portfolio might do extremely well over the next few years, because interest rates have climbed a lot, and if interest rates are going to start falling back at some point, then that's actually a good environment for bonds and capital appreciation of bonds. So your bonds might actually look really good in the next little while, because not only are your interest rates on new bonds much higher than they were before, so you're getting, let's call it 4 or 5. If you're going to higher risk bonds, you might even be getting 8% on some bonds. So you're getting a distribution of 8% or 4 or 5, whatever it is. But you might also get capital appreciation on your bonds in the next few years if interest rates fall back because of a recession. Likewise, if you're looking at the stock market, like stocks have gone on sale. I mean, you got to stick to quality, in my opinion. Like, don't get super speculative out there right now. But if you're buying high quality assets, high quality businesses and companies, they've gone on sale in the last year. And frankly, this is probably the best buying opportunity that you've seen since the bottom of the 2008-2009 financial crisis. So this is not the time to be running away from the stock market. This is the time to be buying into the stock market, to be buying into these assets that have absolutely gone on sale. I mean, people are funny. We buy things on sale. Like, if your car went on sale and it was down 30% from what it was a year ago, people would be clamoring at the doors. They'd be sold out. Likewise, groceries. I mean, I'm from Winnipeg. We love a deal here. Bread goes on sale. If it's down 30%, guess what? Safeway's selling all their bread. But when the stock market goes on sale, people run away from it. Yeah, that's the exact opposite of what you should be doing.
Yeah. It is a funny thing. Even if you think about, you talk about a car going down, people would buy it. Groceries going down, people will buy it. But yet, stocks going down, people run away from it. And real estate goes down, people run away from it. And you sit there and, within my circles, we've been talking about, we're very excited in the real estate market because, you're already getting 10 and 20% discounts at this point, and we're like, okay, here we're going into winter, which only helps that cause right now. And that's just a reality from the investing side of it, right? And people are always wondering, well, should I stay? Should I sell? What should I buy? What should I do? And the question is always, well, what's your plan? What are you trying to do long term? Because we know that we are in, at a minimum, a two-year recessionary cycle. It typically takes about 2 years. If this is a normal cycle, it typically takes about 2 years for us to get out of it. So if we just go on that basis, hey, if you're going to need money in the next 2 years, maybe now's not the time to tie up all of your cash, right? Or if you're retiring. What's your thoughts?
Yeah, really good point. So first of all, like if you need, I completely agree. But if you need money in the next 2 years, like if you need it for something, like whether it's like to buy an asset or to live off of it in retirement, that money should be nowhere near the stock market.
Right.
Ever. Like it's not like, don't get speculative on that because you have no idea what's going to happen over the next 2 years. I think that the reality is the markets probably are going to look really good over the next 2 years. I think that's just based on history. That's probably what it's going to be. But the reality is we don't know that. I don't have the crystal ball on that. And so if you need that money, especially to live on, it should never be, short-term money should never be near the stock market. And it shouldn't be in speculative assets anywhere, really. It should be in much safer assets. So I think that's what a lot of people get away from. And this happens all the time because, when there's opportunities to, like, people ask me, it's like, what's going to look good over the next 6 months in the stock market? I have no idea. Because, like, guess what? I can go and buy, Google or Alphabet today, I should say. I could buy Alphabet today. It's down 6.3% or whatever it is right now because it had a little bit of a tough report last night. What is it going to do over the next 6 months? I don't know.
Yeah.
But is it going to be a good company still? Probably.
Yeah.
So, but anyway, the point is,
6 months is the wrong time frame to be looking at when you're talking about what we're talking about.
Yeah, you shouldn't be buying companies unless you have at least a 5-year window, 5+ years, I should say.
Yeah.
Because you could make, odds are you're going to make money over those 5 years based on history, but the reality is you can't rely on the volatility of what's going to happen there. So anyway, getting back to, how long is it going to take now for like the market to recover though? I think what's going to happen, and this is in most cases, the market's not going to wait for the recession to be over. It doesn't wait for good news to be like at the peak. All it needs is like a little sliver of good news, and the market's already looking past the recession. So most markets begin the recovery. Like frankly, we might be in it now already. But
we've seen a rally going on. The S&P 500 was at 29,000 then, and right now it's back up around 31 again, right?
On the Dow, yeah. So we've seen. I don't know what the total has been over the last couple of weeks, but it's been nice. It's been a nice couple of weeks.
Yeah.
I don't think we're necessarily out of it. It's just my feeling. I don't know.
Yeah.
But,
I think it's a little early for that rally, but yeah.
Yeah, there's still stuff to work out. But most markets, when the recovery starts before the recession hits, or certainly before the recession ends. And you go back right through history because it's already looking past that stuff. So what's really dangerous for investors right now, and keeping in mind what I just said about short-term money, but what's really dangerous for investors right now is there are a lot of people that, because again, it's human nature to run away from pain. There's a lot of pain out there. They've run away from it. They've gone to cash. And the answer is, I'm going to wait till things get better and then I'll come back in. The dangerous part of that is you've just missed the best investment opportunity. You've likely missed years worth of potential investment growth. And you're never going to get that back because time is the one thing that you can never get back. So you miss this opportunity, you never get it. So I think that's really dangerous. What investors need to be doing first and foremost is sticking to their strategy. So if you're feeling like you want to cash out, one, I think it's a good time to reassess the assets you own. Are they quality assets? Are they likely to do well over the next, whatever your time horizon is? Are they the right assets for you? And again, knowing that you don't have the crystal ball, but sticking to your process in that. And then the other side of it is, if you have the ability to buy more, now is the time to do it. And again, this isn't me calling the bottom. This isn't me saying the next 6 months are going to be the market's going to roar. What this is me saying is that from a valuation perspective, this is the best opportunity you've seen since March of 2009.
Wow. So professionally, what's your biggest warnings and your biggest recommendations for people right now in 2022 as we're ending out this year?
So I think the biggest warning I would say is understand your time horizon of when you need the money, when you want the money, and make sure that the asset classes you own are correlated to that time horizon first and foremost. Do not buy the stock market as a get-rich-quick scheme. That's the biggest mistake investors make. They think it's this get-rich-quick scheme, and it's not. And then they start thinking it's like, oh, the market screwed me. It doesn't work. Incorrect. It works, but you have to have the right mentality around it. And I get it. It's really hard. It's no different in real estate, frankly. You have to have the right mentality around what this money is meant for and what your time horizon is. So understanding when you need the money and then buy the asset classes that correlate to that time horizon. But for your longer-term money, the biggest opportunities are happening right now. And you're right. I mean, you could talk about, real estate in that breadth as well. I think that, there's been opportunities from the buying perspective that people haven't seen probably in a while as well. And so that's great. But I think that the biggest risk is not knowing yourself and not understanding your own goals.
Yeah.
And also making sure that you have a strategy that you can stick to, because this isn't the last market or economic downturn you're going to face. I mean, on average, this type of market happens throughout history. This happens every 4 years.
Right.
It hasn't happened since really 2008, and that's why we all forgot about it. And there's a lot of investors out there who have never experienced it. So we've all forgotten what this feels like, but guess what? This happens on average every 4 years. It has happened every 4 years throughout history. So you will see another one of these, and you need to be able to stick to your process throughout that.
Yeah. Well, there's two pieces there that. One, I was through 2008, and I'll be honest, I thought 2008 was it. When that happened, I thought, this is the event. And I actually spoke with a friend of mine at the time, a poli-sci guy, and I said, if we survive this, it's because some guys are going to go into a back room, they're going to have some conversations, and they're going to say, this is what we're going to do, and there's going to be a whole bunch of something that comes out on the other end. And he was like, what are you talking about? I said, I don't know. That's just history. That's how these things happen. Otherwise, if you leave it to a committee to sit around and figure this out, we're over the edge before that happens. We already have that. That was the 1930s. That was the Great Depression. I said, here, this is something that's going to be happening. And sure enough, that's
pretty much what happened.
Right?
Yeah.
Now, but what I learned out of that was you can never know the event that's going to be the death blow. Because they all look like the one before. You just don't know which is the one that's actually going to be the death blow. And so you have to learn to be able to keep moving forward, make the best decisions possible in that scenario, and make sure you've got your hedge. Make sure you've got your protection, which I think you've already talked about. You've already outlined, which I didn't know enough about in '08, and I was like betting on a roulette wheel. Okay, here we go. And I would say what you're sharing is vitally important for the listeners. Now, here's the other piece that I'm curious about to get your take on. The other part from an economic standpoint is the faster we go in and out of these cycles actually speaks to the volatility in the market. And we've actually been speeding up on how quickly we're going into these recessions, right? With the volatility in our markets. That is, they say, is an indicator and something for us to take into account. Mm-hmm. A, do you agree? And B, what are you guys doing to manage that and manage that risk?
Yeah, so I agree for sure. I think that technology and access to markets, and I'll just speak from the market side of it. I'll talk about stock markets in general here, but it really applies to any investment structure where you can buy into. The access to it has really been democratized to a great degree. Like, if you wanted to go buy stocks, like, I don't know, like 75 years ago, even 50 years ago, 40 years ago, you had to go talk to a broker. You had to go phone them, blah, blah. There was all these hoops to jump through, and they were the only ones who had market access. Today, anybody with a smartphone has market access. So you can, here's the difference actually from an advisor relationship to what it is today to what it was before. Before the advisor had the access, you needed the advisor for access, and that's a large part what you were paying for. Today, you don't come to me or Endeavour Wealth to get access because you can get that on your own. What you're coming to me for is advice around that access, and how that relates to your goals. So, but what it's done though is everything's sped up. Market movements have sped up because transactions happen like this.
Yeah, that's true.
They're very, very quick, and the market gives you real-time data, which is now in the palm of your hand. So, one of the biggest differences between stocks and other asset classes is it's valued every single second of every day that the markets are open. I mean, not many other asset classes are like that. And what it does is create this gamification around it. And it makes you feel like, there's legitimately people that do gamble in the stock market. I don't agree with it. I think it's silly. But because of it, it's like, hey, I'm gambling, I'm betting, it's like sports betting. It's all that, it creates this gamification around it, which is dangerous. And all of that stuff adds to volatility and so on and so forth. Now, the good news is for disciplined investors, it creates liquidity too. And liquidity is good because for anybody that's a really disciplined investor that has a strategy and a plan, liquidity is good because you can take advantage of liquidity because things are going to go on sale at a time. Like, things are going on sale more than ever before too. So you get these sales and it's like, I'm going to buy the sale. Just keep buying on sale. And if you can do that, then you're going to do extremely well over time because quality does rise to the top still. And good companies that make lots of money will do well. How you handle this level of volatility is exactly that. You need to have a solid plan in place. You also need to have the ability to stick to your plan. The stock market is not for everybody. The volatility that you see, do not fight your own human nature. If you are feeling uncomfortable, if you're feeling stressed out, then it's not worth it. And so there's a balance of like growth and volatility and what you're willing and comfortable to handle. Most of my clients 100% cannot handle 100%. They can't handle 100% stock market investment. It's too volatile because you have to be prepared to go down 50% in value in a single year and stick to your plan. I don't know how many people can feel like I can do it because I understand how it works, but not many people want their net worth cut in half in 12 months. And they're going to feel like, oh, I can stick to this, Yeah. That's the challenge in investing in these types of assets that can fluctuate. And so how you combat it, honestly, the short answer is you need to have a plan that you can stick to and remain disciplined to. You also need to have a broad range of investment asset classes, I think, in your portfolio.
Yeah. Grant, that's why I like you, because you got such big cojones. Because I'm one of those guys. I'm not comfortable with with the volatility in the stock market. Can you imagine that? I talk about investing and all of this kind of stuff, and I leave it to the professionals to get into it when you talk about it in the stock market. And I've found, there's people on both sides of this of that fence, and I'm one of those ones. I like the hands-on nature, and everything that you talked about with regards to the speed of it. There was something in me that it always concerned me. Hence the reason that I went down the road of real estate, because I'm one of those guys where real estate just intrinsically made sense to me. I could see it, I could understand it, and I built that way. And so I love what you're sharing there. If you're not comfortable in that area and you're not comfortable on doing something on your own, that's why you go to an Endeavour wealth management firm. That's why you do these types of things and bring in the experts to be able to assist you.
So I'm not an advocate for holding any 100% of any asset class. Just to be clear, like real estate, because it doesn't get priced in the same way. It's not priced as often as like a stock market investment. I wouldn't still own 100% of my assets in real estate, but I do think that people should own real estate. People should own stocks. People should own like hard assets. You name it. Like, I think that's all important. Private equity, all of that kind of plays a role. Yeah.
Okay. So, you guys have really been able to balance out, survive through this year, with some of your agnostic investments, some of these types of things, and going forward, what's happening here? Where is Grant White and Endeavour going forward from here?
Oh, so these types of events, when they happen, for any of the entrepreneurs out there, especially, these are what I call 40x events. Because the goal should be that your business has the potential to be in 10 years from now, 40 times bigger than it is today. And the things that you do today can set that in motion. And so where, just from a business perspective, what we're doing is trying to take advantage of every opportunity we can to set ourselves up to be 40 times bigger 10 years from today. And I think for all the business owners, the professionals that are like entrepreneurs growing their businesses out there, that's the way you need to look at this environment, because there are a lot of people, just as an example. So Alphabet reported they didn't have a great report because ad spending is down. All these companies are reducing their marketing budgets right now because it's something they can reduce to save cash.
Yeah.
If you have the ability to do more right now to grow your business, I think you need to, because your competitors are sleepy and scared.
Right.
So now is the time.
Yeah. So you're right. We're absolutely seeing cutbacks across the board. I do think that there's more job cuts to come. And it's interesting what you're talking about there with regards to the ad spend, which really means for those that have the ability, you can really go and dominate a market get more visibility in some of these things, and that's really powerful. And in the different asset classes, do you have a prediction on what moves right now over the next couple of years?
Everybody wants to know what I've seen in the crystal ball.
What's the crystal ball? Like, come on, Grant, you're holding out on us.
High quality over the next 12 to 24 months. History tells us they should look pretty good. There's a lot of things that have gone on sale, and a lot of the events that we're seeing that have caused that market sell-off, those are short-term in nature. So actually, one of my advisors here said this the other day, and I thought it was really cool. He said, every bear market ends except for the one that you're in, because the feeling is that the one that you're in is never going to end. Guess what? It will end. And it's going to end before you know it, and it might have ended already. You don't even know.
Right.
But the point is, I think over the next 12 to 24 months, stocks in general are going to look very good. Which ones, it depends on the individual, to be honest. So I won't make any give you any stock tips out there. But I think that the broader market, if you bought the S&P 500, for example, in the US, it's probably going to look pretty good over the next 12 to 24 months.
Yeah. Wow. Well, I think you're a little bit more bullish than I am. I feel like like we still got a little bit ways to go. It's just part of that sentiment, It's like it's especially with the U.S. saying that they want to continue to raise rates, and knowing that Canada will have to follow suit, hence, or in our case, be preemptive, which we just did today, and we expect it again. So I feel like there's still something to price in, but I think that's the beauty of the opportunity. I'm with you completely on that front. Anything we didn't cover that we should cover quickly? Because I've kind of gone over your time now. What do you got, Grant?
I think the one thing I'd say is this. I mean, these types of events end before you know it. And then, I think you make a good point, Neil, is that, are we out of it? No, I'm not saying we're out of it either. But what I am saying is that if you have a long-term horizon on certain assets, you need to buy when it's painful, and if it's your business, you need to make changes today when it's painful to do so. And it's specifically talking about building wealth. Yes. You need to make those hard. That's what good investors do. That's what the best investors in the world do and have done throughout history. And so these are those moments. So if you're looking for building your wealth, I don't think you've seen such a great opportunity in over a decade to do that. And so now's the time to take advantage of that. But you need to be prepared that the pain might not necessarily be over. And the next 6 months in particular, I think, could still be quite painful. But don't worry about it. If you have a longer term time horizon, don't worry about the next 6 months. Continue to think longer term to the horizon.
Yeah, that's a great point. That is a really great outlook and viewpoint. I remember in 2008 when Goldman Sachs was $50, and I was considering buying, and I let someone talk me out of it, and we all have one of those events, right? So I like the viewpoint. I appreciate you sharing that with us, and we'll definitely share your how people can get in contact with you. Anything specifically that you want to let people know about any events coming up?
No, I mean, I'd love for people to come visit on our website as well. Because, we have all our events and things. We're always doing stuff there, and lots of webinars and online events too for people that aren't in Winnipeg with me. But we do lots of events. So feel free to go to our website, which is endeavourwealth.ca, and, love to connect with people there.
Love it. Ladies and gentlemen, Grant White from Endeavour Wealth Management. Grant, thanks so much for coming on again. We really appreciate you coming in, sharing on a lot of topics that I know a lot of people would not say anything about. And we stayed away from that thing that sounds like Rowwood. We didn't talk about that at all. So,
It's nice
more
change,
conspiracy theories. Yeah, love it. Yeah. Grant, thanks a lot for coming on the show.
Anytime, Neil. Thanks so much.
All right, guys, take care. We'll see you again next week on the Leadership to Wealth podcast.